Hello, my name is Chandler Ryan. Myself, along with Zachary Cagle, founded in 1923, Eastboro Machine Tools Corporation is a long-standing industrial machinery producer. Now, the company stands at a crucial crossroads in its future endeavors. Tasked with steering the company through a strategic transition with intense competition, Jennifer Campbell, Eastboro's chief financial officer, faces a series of financial decisions for the future of her company. Our presentation explores her decisions regarding the company's dividend policy, stock repurchase programs, and the impact of these decisions on the company. Our analysis seeks to address the current market conditions and discern an optimal way forward for Eastboro. In doing this, we will explore an overview of the company and its financial challenges, the dividend policy options, considerations of stakeholders and share repurchase programs, and finally, the proposed company rebranding. Through our examination, we have come to recommend a 20% dividend payout, a small-scaled stock repurchase program, and a postpone of their rebranding campaign until further market conditions settle. Since its beginning, the company has continued to innovate and expand into new technologies and sectors. In the late 1970s, Eastboro began to expand in the computer-aided design and manufacturing fields. By 2000, this new sector of the company was responsible for 45% of sales, while presses, dies, and molds accounting for 40%, and miscellaneous machine tools for 15%. This new industry of CAD and CAM software was accompanied by many competitors, and Eastboro found itself in need of major internal reconstruction to stay relevant. Considering the company's struggles and the events of not only the recent dot-com bubble, but the attacks on September 11, 2001, Jennifer Campbell faced the decision to use the company's funds to pay out dividends to its shareholders or use these funds for a stock buyback or repurchasing program.
Let's talk about the dividend policies and what that looks like from a debt to equity ratio standpoint. As you can see, there is a stark difference between a 40% payout ratio and a zero payout ratio from a standpoint of debt to equity. The 20% payout ratio is. Let's begin by examining the dividend policies and what that looks like from a debt to equity ratio standpoint. The 40% payout looks a lot different in the long run as opposed to the zero payout, but the 20% payout, while it's half of the 40% payout, it's tracking at only 10% debt to equity ratio in the long run. So let's take a look at some more of these numbers. As you can see, with the zero dividend payout, the company begins to free up cash from borrowing beginning in 2003, creating a total surplus of $110 million by paying no dividends through 2007. Now, the downside of this is that while this may raise cash in the long run, investors will likely respond negatively as the company has a history of dividends. The option of a residual dividend policy would allow for more flexibility within the board and less potential debt because they would not be committed to a certain dividend threshold. This policy would also prioritize investing its retained earnings into projects with positive net present value while demonstrating an emphasis on maximizing the firm's actual returns before considering dividend payouts. While they will break into the residual dividend potential in 2003, that may still be a challenge. This strategy may keep pace with the dividend-focused investors in the long run. However, it will likely be a tough sell for those who are upset with the zero payouts during the restructuring year of 2000, and they would be faced with zero dividends for yet another 2 years. While most of their manufacturing industry competitors in the CAM and CAD sector do not pay their investors dividends, this may upset Eastboro investors who expect those regular payments. As examined before, the 40% dividend option would require the company to continuously borrow cash through 2006 and create a cumulative deficit of over $105 million. While this may make some of the dividend-focused investors happy, this increases the overall level of risk for the company because of the higher debt-to-equity ratio that will result from this policy decision. This policy is definitely geared toward a lessening sector of their main industry competition as well. The 20% dividend payout option is the best course of action for Campbell to take for the company. The company will break over into positive cash in 2005. It will create a cumulative surplus of $2.4 million, and it keeps dividend-focused investors happy while decreasing the overall risk for the company because of the lower debt-to-equity ratio that will result from this policy decision. The 20% dividend will also place Eastboro in the top dividend performance category against its major competitors, as the majority of the industry does not pay out dividends. The repurchase of $11.9 million in shares will also signal positively for the company that the managers of the firm are likely acting in a manner of which they believe the stock price is worth more than its current price. This is very likely as the current share price has slumped to $22.15 from its high of $48.23 in 1994. Campbell and her team at Eastboro are very confident in their 15% growth rate estimation from 2001 to 2007. This will create a substantial amount of cash flow in the long run on their balance sheet. However, when comparing the dividend options of 40%, 20%, and residual dividends, you can clearly see there is a stark difference in the amount of cash available as a result of each policy. While it is possible to achieve a 15% growth rate with your new strategy following the restructure, we feel that it is more plausible for them to achieve a 10% growth rate without launching that campaign. Execution of the rebranding and advertising campaign in 2005 would most certainly propel the company to higher growth threshold of 15%. And from a standpoint of cash, they would borrow a lot less cash on the front end by deploying the strategy in 2005 as opposed to 2001. The sensitivity analysis gives us a clear picture of the differences in the dividend policies from the standpoint of total payment as well as excess cash left over. As you can see with the 20% dividend policy, at 15% they have $2.4 million in excess at the end of 2007, whereas if they only achieve a 10% growth, they still have $170,000 in surplus. This two-stage model, once again, is the best way to look at this particular situation, as it gives them some flexibility of them not achieving that 15% growth rate on the front end.
Now we will look at the signaling and clientele effects. Signaling occurs when information is released about a company, and this information release triggers a buying or selling of the stock. Companies may reveal information about their financial health by issuing dividends, buybacks, or debt. Generally, stockholders prefer a well-rounded, consistent dividend, as it often signals a healthy company, and a well-timed repurchase of its stock can signal market positions for Eastboro and to potential investors of an underpriced stock. The clientele effect is a change in share price due to the corporate decision-making that triggers investor reactions. Substantial decreases in stock price may occur when the dividends are cut, and equity is issued to reduce stock prices, and this negative reaction encourages management to limit dividend payout to a sustainable level. Management's attempts at false signaling could also compromise the credibility of future attempts at signaling. Why dividends matter to investors. Investors prefer companies that consistently pay dividends. Such companies tend to grow and increase their dividend payouts annually. Dividends are a good indicator of a company's health. They can protect against losses when stock prices decline, and companies will pay dividends that often benefit from tax advantages, like lower tax rates. When considering an increase in dividends or deciding to repurchase shares, or possibly both, the first thing to note is the similar advantages of credibility, visibility, and simplicity that both of these platforms have to offer. And then you have to think about, is issuing equity a bad idea? I mean, equity is the residual claims to cash flows. There are no fixed returns for this, but they constitute simple, visible, and credible managerial symbols. And we have recommended a blend of a 20% dividend policy with an 11.9 million stock buyback. So we have recommended both.
During a review of the company's standing in financial markets, Kathy Williams, Eastboro's Investor Relations Director, concluded that investors misperceived the firm's prospects and that the firm's current name was more consistent with the firm's historical product mix and markets than those expected in the future. The company's proposed shifts to Eastboro Advanced Systems International, Inc. marks more than just a change in the name. It would symbolize the company's strategic repositioning from a conventional machine tools manufacturer to a leader in advanced technological solutions. In doing this, Eastboro can increase brand visibility and reshape the public opinion by highlighting its commitment to innovation within its sector. However, this brand shift comes with a significant cost. Williams estimated that the image advertising campaign and name change would cost the firms approximately $10 million. It is crucial that these efforts align with Eastboro's actual technological offerings and strategy to avoid any potential confusion in investors and ensure its effectiveness within the company. If executed well, the rebranding could enhance Eastboro's long-term brand equity and position as a leader in the new industry. Nevertheless, this investment in rebranding must be carefully considered and weighed against its potential returns, especially given the recent market conditions of the dot-com bubble and September 11th attacks. Based on our analysis of Eastboro's Machine Tool Corporation's situation and market conditions, we propose several steps for improving its position. First, implement a 20% dividend payout to balance shareholders' interests with capital retention. Second, initiate a modest stock buyback to boost shareholders' value and confidence. Lastly, we should delay Kathy Williams' costly rebranding plans given current market volatility. This approach aims to focus resources on immediate needs, reduce debt, and position the company for growth post-restructuring.